Okay, for video 2, we're going to talk about forecasting. And forecasting usually represents a couple things. One is we're into our budget, we're into the budget year, and all of a sudden some things have happened that now we've got to change course on. So we're going to reforecast the budget year and come up with a new forecast for the end of the year. The other thing we could do is project into the future and use these forecasting techniques for the next couple of years to kind of see where we're going to go with the budgets and the potential projections with some of the decisions that we've made. So there's a couple forecasting methods out there. The most common one is the naive forecasting, right? And it is kind of what it sounds like. We're estimating technique in which last period's actuals are used as this period's forecast. So we're basically saying everything's going to be the same. That might be a little naive. So that's naive forecasting. Casual forecasting is where we'll use past variable relationships, look at the last couple of years, let's say, and look at the cost and the revenues and the inputs and outputs and sit back and say, well, hold up our thumb like an artist and say, it looks like it's around this amount of money, so that's what we'll forecast. That's casual forecasting, which is another commonly used forecasting method. Judgmental forecasting, that's where we're using the knowledge of past outcomes or changes to subjectively forecast the future. We might sit there and say, hey, remember when we did that marketing promotion and it really jumped sales up? Let's assume that we're going to have that same jump in sales based on what happened in the past when we did that same marketing promotion thing. So it's kind of a judgmental, subjective forecast that we're putting out there. And then time series forecasting, which we're going to use the historical totals as a basis for estimating the future costs. So it's more of an analytical process of casual forecasting when you think about it, instead of coming up with putting up your thumb as an artist and trying to figure out what it is. You're actually going to use the empirical data to try to come up with the trends. And what you'll do too is have relationships between other costs that affect that. So that's more of an analytical judgment of what that potential forecast number would be. Now, how often do you do forecasting? Well, some people do it weekly, monthly, yearly. When I did some work at a local not-for-profit, we were doing it daily because we were very concerned about the daily sales that were going on. So it depends on the industry. And you could also have rolling forecasts, and that's where you're projecting out into the future, but you're always moving the month. So normally you'd have January to December, but once January's done, now you're going to do maybe February to next January, and then March to next February. So you're going to kind of move that calendar along just to see how you're looking and comparing with the historical data with that future data so that you're really coming up with what you think is the best forecast. All right, so that's our overview on the key terms of forecasting. Let's talk about where this information gets applied to at times. The annual filings. Most annual filings will require actual results, but they may require that budget information, both of the past to see how you did and the future of where you're going, and maybe even projections in forecasts into the several years future, especially when you're doing a prospectus for a publicly traded company. But let's get into the reporting that local governments and school districts have, and that's the AUD, and that does not stand for audit. That stands for annual update document. And villages, towns, fire districts, schools, they all have to file this with the state. It may require a CPA audit. Schools always must have a CPA audit, but the other entities like towns and villages and fire districts don't have to have an audit. If they do something where they use federal funds, then they have to do what's called a single audit. And an external CPA is coming in and reviewing these grants that they've gotten from the USDA or large state grants, other federal grants. Anytime you spend federal funds over $750,000, you are required to have a single audit. And that audit will go into the controls of the entity and also present the financial figures related to it, as well as focused on that specific grant money to ensure that that's been handled properly. Now, when we talk about not-for-profits, we're talking about the 990. That's the federal form, just like you fill out a 1040 for your personal taxes. The not-for-profits fill out the 990. The federal government and in the New York State, they fill out what's called a CHAR 500. Now, The 990 is in several forms, kind of like the 1040, the 1040 EZ for your personal side. They've kind of done the same thing in the last few years with the 990. So you can go to the irs.gov and get these forms and publications, but if you have revenues less than $50,000, then you just have to file what's basically a postcard that says, hey, I had revenues less than $50,000 and I'm out here and I am doing work. So you file that and you're set. When the receipts are less than $200,000 and the total assets are less than $500,000, but you still have more than that $50,000 gross receipts, then you file what's called a 990EZ, which is a smaller version of the big full form 990, which is for everyone who has over those other criteria related to the EZ. And then when you get to the CHAR 500, which didn't always align with the 990, it's recently tried to align with that, but you can go to the charitiesnys.com to get that information. Exempt only if gross receipts and assets are less than $50,000, but you still have to file a fee. And it's interesting because I always joke that New York State only taxes on one thing, and that's everything. So the fee is scaled based on the net worth of your not-for-profit. So the more assets you have, the more fee you have to pay. And they also have some audit and review requirements where you have to have a CPA come in and examine your financials when your revenues are greater than $250,000. They want to make sure that you've got the controls in place and that you are reporting properly. So if you ever want to find a not-for-profit's 990, you can go out to the Foundation Center. You can also look at some of the other ones I've listed there. Go pull out that 990 and check it out. And it's kind of important because if you're going to work for a not-for-profit, you want to look at that 990. You want to, make sure that whatever purpose you think you're getting into with that not-for-profit is actually the purpose and the goal that they have set up for themselves. Now, financially, you might want to look at the assets. Are they increasing? Are they decreasing? Which assets particularly are increasing and which ones are decreasing? That could be an indicator of what's happening with the entity. Just like the fund balance, if it's decreasing regularly, they're using that retained earnings that they've stored up and they're going to run out of it soon. So that's something you should know. But one of the other factors that's pretty important is revenue, because knowing what kind of revenue is generated by that entity might determine what kind of work you do for that entity. If it's a lot of federal grants, then it's going to be a lot of paperwork and lining expenses up with those grants. But if it's donor support, maybe it's going out there and meeting with donors and telling them about your mission and getting them to try to donate to the entity. And it could be operations where it's just based on what you do and how your operations roll. So that could impact what type of organization you go to because it might meet or not meet your skill set. So those major donors are a big deal too, because if it's one or two major donors, you know that if one of them gets upset at the organization and goes away, potentially that could be a severe crisis for that not-for-profit. Some of the support, or is it most of the support? So that's a big deal when you're looking at what the major donors are, and it's listed in that 990. Debt to fund balance, comparison to similar entities. So what does that mean? Well, do they have a lot of debt compared to their fund balance? Can they pay that debt? Now, maybe they have a lot of fund balance, which means people have donated or their operations have been successful, so they've got fund balance to cover things. If it's way driven by more debt than fund balance, there might be some troubles with that not-for-profit. Now I'm just going to finish up with a quick rundown on those Excel budget spreadsheets that we looked at. All right, I'm going to briefly highlight a couple things so you're familiar with the terms. Static budget, and that really means a budget that we set and we don't really move throughout the year. So you'll notice that this particular entity has different volumes, and they base their budget on the fact that in this middle column, they thought they would sell 1,100 units for the year. They do all their actual results against that static budget, but you can look at how big some of these favorable and unfavorable variances are. So what we did is we came up with a term called flexible budget. And flexible budget adjusts the budget based on those actuals. And you'll notice that 980 was not in our original assessment of costs. So when we have adjusted this to flexible, it gives us lower variances, or it actually shows that in this variable cost, which was favorable under a static budget comparison, is actually unfavorable in a flexible budget. So we might have thought we were doing good if we'd have stayed with a static budget, but when we compare it with the flexible, we realize that maybe we had some variable costs that were not working the way we expected them to do. Now, let me just do a little jump off into the weeds for a second on variable costs and fixed costs. So variable costs are, if we had that pizza shop, they're the things that are directly related to how we make those pizzas, such as the cheese and the dough and the sauce. So we can come up with a particular contribution margin, which is the revenues minus those variable costs, which means each pizza that we sell contributes so much money to covering our fixed costs. And remember, fixed costs will be those things like rent that won't change throughout the year. So you'll notice that when we did our initial budget, we figured $5,000 would be our fixed cost no matter what volume level we were at. But when the actual results came in, believe it or not, there was a little bit of a change, and that could have been utilities that we just thought we would have the same electric bill throughout the year, and it did have a little bit of fluctuation there. So you'll see that this contribution margin and what these pizzas contribute will hopefully cover fixed costs and potentially give us an operating income. So that's why I wanted you to be familiar with those particular terms. But now let's move on to cash budget. Cash budget is one of the most important things out there, especially if you're a not-for-profit and you're just trying to figure out how your expenses are going to get covered. So you convert everything to a cash basis. And that cash basis means whatever inflows we have, whatever expenses we have out based on cash, affect that ending balance. So you'll see I've changed everything from revenues that would be based on even accounts receivables or IOUs that are out there to what cash did we actually receive. And expenses, I've forgotten about payables that we haven't paid and focused on what did we write checks for. So if we project that into the future on what we think we're going to receive in cash and what we think we're going to spend in expenses, it gives us a projected operating cash balance. And really, companies that are running on donor support or grants really need to do this. And then they'll find out, well, we really need to figure out how much more development we can get in February, or else we're going to have some problems. So loans required, how much loans we need to stay in business, and then maybe how we're going to pay off those loans in the future when we expect to have enough cash to start paying off those loans. So this is why the cash budget is very important. And that concludes our overview refresher of budgeting and forecasting for DEXL 715.